Hey, what's happening, guys? Dan Dyro here with another Options in Play video update. So Snap was the big news of the day. Everybody's talking about it because, I mean, not only has it led to Snap stock cratering, but it's basically knocked over just about every tech stock too. So it really has been a gigantic drop on Snap and a huge drop on so many other names. And I mean, it was a mid-quarter guidance update. Really hard to see that come in. Um, but what was interesting about Snap was that it kind of like one of those setups where it just seemed like it was due for a move, right? This was what the focus of the strangle strategy was on. Um, Initially, it was when the stock was dancing around this really kind of critical like upper support level around 28, right? So post earnings didn't have much of a move. It was dancing around this 28 support level. So we were looking at it either as a candidate to bounce back into the 30s, right, which it done like the previous two times, or if it broke down, looking for the gap fill, and then ultimately lower prices. So stock broke down,
Test radio,
stuck
test
with some
radio.
options, right? And what what we were thinking coming into the week, and what I was thinking was just that the stock was kind of due for a move, right? Because it was an increasingly tight lower range, sitting just off its low. Seemed like it was either due for a bounce or another breakdown, and then the guidance clearly led to like another leg down. So when it comes to spreads, right? And this is like something that applies to just about all of my option trades when they involve spreads. So there's two things. So when the trade is capped, to me that's when I say a spread is capped when the stock is trading above the top end of a spread if it's a call spread, or below the bottom end of a spread if it's a put spread, right? So I say the trade's capped. That means that the stock is above the short end of the spread, right? Or below the short end of the spread if it's a put spread in this case. That doesn't mean that the spread is fully realized, right? That doesn't mean it's maxed out. It just means that that as the stock keeps going in that direction, right, that your potential gain for the spread will only be the amount that the of the spread, right? So if the spread's 3 points wide, then the max you can make is $3, right? Like that's the most you can make on a put spread if it's 3 points wide. So if the stock keeps dropping, yes, you could realize more premium for the spread, but at the end of the day, you can't make more than three because that's how wide the spread is, right? So if Snap dropped another 5 points, you could only make the most you could make is what the spread was, all right? Um, so that's why, like sometimes if you do have like a big gap and it trades through the bottom or top of the spread, I like to like roll a little bit more quickly, just because if I think there's more potential, like obviously I want to be able to capitalize if there's like another bigger drop or bigger rally versus what like the spread potential is. Okay. Now the other thing with like a max gain, right? So for options to realize the max gain, most of the time you got to wait till expiration, right? Sometimes if it's like a really gigantic move and the options are deep in the money, it might be trading close to fully realized, but a lot of options you have to wait until expiration, and then that adds an element of risk, right? Because if a $3 wide put spread is trading for 290, right? Yeah, you could hold till expiration and maybe realize that extra 10 cents. At the same time, you run the risk of the stock maybe coming back, and all of a sudden, you were risking 290, which is what the current spread is worth, to maybe only make 10 cents. And does that really make a lot of sense from a risk to reward perspective, right? Because, sometimes you don't know. I mean, like, yeah, it might not look like it's going to bounce, but things can happen, right? Things are unexpected. And sometimes, news comes out of nowhere, just like today's announcement. So when you get to the point of an option spread worth more than 50% of the realized value of that spread, then that's really like the time where you need to decide, okay, how long do I want to hold this? Is the risk to reward worth it, or do I want to just take the trade here and wait for a different setup, right? Because once you start getting above that 50% realized gain, then your risk increasingly moves against you, right? So if the option spread is 60% realized, then you can only make another 40%. If the option spread is 70% realized, then you can only make 30%, right? And if somebody came to you and said, I got a trade where you risk you risk 80% to make 20%, a lot of people wouldn't like that, right? So these are the things you really want to think about when you're trading these spreads, and especially when the stock has a big move. It's okay, do I think there's more potential? Do I want to roll down quicker or roll out quicker? And also when it comes to like the realized value of the spread, what's the risk? Like, is there a chance that this has like a big bounce, and if the spread is more than 50% realized or 60% realized, is that a risk I'm comfortable with, right? So food for thought, and things that I tend to really like go through when I'm in spreads that have like a giant move, and I think it's something that you really need to be mindful of when, especially if you trade spreads pretty actively. Okay. So it should be a busy conclusion to the week. Still a lot of big earnings, so we'll see. We will see. All right. So if you like this video and you're looking for more information about trading options or trading spreads, please follow up with the link in the description of the video for more information on options to play. Have a great night. Stay well, and I will talk to you.